What if the most common piece of advice you've ever heard as a trader is actually a trap? So for decades, right, we've all heard to make money, you got to buy low and you got to sell high. But what if that approach is simply flawed? Today, I'm going to show you the simple shift in mindset that traders use to enter the market with more confidence. And no, this is not about a secret algorithm or indicator or any risky shortcut. It's all about waiting for the market to show its hand and trading with proven momentum. Let's get into it. So let's start with the lie itself, right? That you should buy an asset pretty much when it's falling, right? Hoping to catch that turn. So on the surface, that just looks like the whole buy low part of the old mantra of buy low, sell high. But the problem is that whole idea that hinges on one nearly impossible skill: knowing when that asset is going to stop falling. That common advice to buy the dip sounds great, but how do you know if it's a small dip or the start of a massive crash or a trend change? Well, the truth is you don't. When you buy into something that's moving down, you are essentially betting against the current momentum. So a much more reliable indicator is a sustained run in price. A big move up is proof that there is proven interest in the instrument at that time from other traders and, depending on the instrument, institutions. So why try to guess where the interest will be when you can simply follow where it already is? So if buying with momentum is a better idea, why are so many people afraid of it? The answer is simple, and it's rooted in our own psychology and two of the most powerful emotions in trading: fear and greed. When that market's ripping higher, the fear of buying the top kicks in, right? Nobody wants to be that person who buys right before the pullback. Totally valid concern, but then it leads to inaction. And this is where traders end up missing the entire trend because they're waiting for a deep discount that may never come. On the flip side of that, when an asset has already made a big move and starts to pull back or consolidate, fear takes over. The instinct is, it's over, the run is done. We stay on the sidelines. We fail to see the difference between a healthy consolidation, where the volatility drops and price range tightens, and a true reversal. So do you see the pattern here? Our fear prevents us from buying into strength, and then it prevents us from entering during a healthy pause. So we miss the initial move, and then we miss the even better opportunity that comes after that. So the real trap is not understanding the life cycle of a price run. A big move up shows interest, but the most strategic entry point is often right after that initial excitement has calmed down. So if buying a falling asset is the lie, buy low, what's the truth? It's a powerful concept. Wait for momentum, enter on the consolidation or the continuation from it. This strategy is about letting the market prove itself to you first. Instead of you trying to predict the future, you're reacting to what the market has already shown you. You're trading with the flow of money, not against it. And this approach is built on two simple but very powerful concepts that any trader can use. The first one is identifying momentum. This simply means look for a stock or an asset that has already had a significant sustained run in price. Don't look for things that are beaten down, especially if you're a new trader. Look for things that are showing clear strength. That initial run is evidence of high interest and demand. But you're not chasing this initial move. You may not even have a chance of catching it anyways. You're just simply identifying it as a potential candidate. Now, the second and the most important part is wait for that consolidation. No trend moves in a straight line forever, right? After a strong run up, there's almost always a pullback or a period of sideways trading. That's the consolidation phase. This is simply where the asset takes a breather. You'll often see volatility decrease as the price range tightens up. This quiet period is going to shake out impatient traders. It's going to build up energy for the next move. So your job is not to buy the initial breakout, but to patiently wait for the consolidation to happen. By entering the trade as the price starts to move up after the pause, you're trading the next leg of the trend. This is a higher probability entry because the initial momentum has proven there's interest, and the consolidation has provided a more defined, lower risk point to get in. So here's a simple 3-step plan to avoid that biggest myth. Find the proven runners. Simply scan the market for assets that have already made a strong, clear move higher. That's your watch list. And we're looking for a strong first leg, right? Ask yourself, would this move deserve another leg, right? Look at the quality of the move. Secondly, wait for that pullback. Don't buy yet, right? Watch the asset. Wait for price to stop making the new highs. Pull back, trade sideways. Ideally, you want to see volatility die down. Daily price movements get smaller. The trading range should tighten. This is the consolidation phase. The key here, though, patience. Let it come to you. Now, here's the key. We do not want to see that instrument give up a large percent of the recent gain. That's not productive. Finally, enter on the next leg up. Once the asset has consolidated, your entry point is when price begins to rise again, breaking out of the consolidation pattern with volume. That's your signal that the trend is likely resuming. By entering here, you're trading with the established momentum, but at a much more strategic entry point than those who chase the first run up. Advanced, look for a break below support in the consolidation and a quick buyback above that support for an entry. So that's it. That's a strategy. Being a disciplined trader who waits for proven strength and then acts on a high probability setup. Now, straight up, there's a lot of nuances to this. You will learn these as you go through hundreds of charts as homework every single week. Pattern recognition of successful price moves. This is something that you need to learn. What does a good first leg look like? What does a productive consolidation look like? These are things that you need to work out on your own. This is not something you can be taught. So if this video helped you see through the noise, do me a favor, hit the like button, subscribe for more trading advice like this. I'd love to hear from you though in the comments. What's the worst piece of trading advice you've ever received? So remember, the goal is not to perfectly time the bottom. It's to let momentum prove itself, trade with that proven interest.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.